Alright guys, today's presentation is going to be on the 10 chart patterns that you guys should know at all times. These chart patterns will help you trade, uptrend, a downtrend, a consolidation market. It's good to have them on your side at all times as you're trading. Just to clarify certain trends or certain patterns that you may see in order to confirm it. So the first one that we're going to is going to be the head and shoulders. So a lot of you guys may be familiar with it because you'll probably see us on the Zoom from time to time live saying that, oh, there's a head and shoulder here or there. So what is the head and shoulder? A head and shoulder is a chart pattern in which a large peak has a slightly smaller peak both on the left and right side. Traders look at a head and shoulder pattern to predict a bullish to bearish reversal. So looking at the head and shoulder here, the first thing that I did mention is that it has three peaks. So it'll have a shoulder on the left side, a head in the middle, and then it will have a second shoulder to the right. So you have three peaks. So within those three peaks, between the three peaks, you will have a resistance level, and that you usually find that between the two shoulders. Those are usually where price gets rejected the most. So just some key things to keep in mind. The first and third peak are smaller in height compared to the second one. So if you're looking at the two shoulders, they're always smaller than the head itself. And then the second key thing that you will see is all three peaks always fall back to the same support level, also known as the neckline. So if you're looking down here, you'll see that every time that price gets rejected at the resistance above here on both the shoulders and the head, it always comes back to the neckline just to bounce back up again. But usually on the third peak, price usually comes down, probably consolidates a bit here before breaking down to the neckline, and that's where you will look for an entry to the downside. So if you're playing options, of course, since this is what we do here, you'll look to establish a put position, right? So you'll look for a break of support at the neckline for proper entry, followed by a strong bearish candle formation. So you need as much confirmation as possible before getting into the trade. You don't simply just, jump in. Although it is doing the head and shoulder formation, that doesn't mean that it's always going to play out. Sometimes you may have a false breakout and it could completely disregard the entire formation itself. So it's best for you to look for a bearish candle formation and also look for volume to support that reversal. Look for volume to support the reversal, right? You always want volume on the side of which the breakout is happening. That's what's going to support, the price movement, and that's also going to be an additional confirmation for you to get into the trade. So next up, we have the double top. A double top is an extremely bearish reversal pattern that forms after price fails to break above two consecutive pivotal highs with a moderate decline between the two highs. So looking at the double top, you'll see that price does come from the bottom, right? It does come from the bottom rise, and it does meet resistance here once, right? Only to fall back to the neckline, which is the support level. And then from there, you'll have another rejection to the upside where price will go back up only to get rejected again at the resistance level before coming back to the neckline, also your support level. And from there, that's where you'll find your entry point when price is breaking the neckline. When price is breaking the neckline over here. So that's where you will look for your entry. So also, just like the previous formation before, look for a bearish, since this is a bearish formation. Look for a bearish candle formation for you to get in. That will be confirmation as it breaks the neckline, and also look for volume to support that breakout. So moving on, we have the double top. So right now, this one right here is a bullish indication, right? A double top is an extremely bullish reversal pattern that forms after price fails to break below two consecutive lows with a moderate incline between the two lows. So as you can see with the double top, price is usually coming down, coming from the from the upside to the downside. So that's when you probably have a minor sell-off within the stock that you're trading or the market itself. You'll see price drops down from where it was currently trading, only to fall at a support level here, where it will then again bounce up, and then it will find a resistance, creating a neckline. And from that neckline, that resistance level here, it will get rejected to the downside, only to go to the support before bouncing up again. So this is a bullish reversal. So what you're going to do is you're going to look for your entry point at the neckline as price breaks the neckline. That's how you'll know. That's one confirmation that you could use for entry. And of course, since this is a bullish reversal, you're going to look for for bullish candle formations as additional confirmation. And also, you're also going to look for volume to support the reversal. So having these three confirmation will let you know that, okay, it is good. It's a good time to enter the trade, because let's say that you do not have any of these confirmations, then it might just go ahead and create what you call a triple top, to where, well, not a triple top, but a double top, to where price gets rejected here and then comes back down here, comes back up here, only to get rejected again, coming back down. Right? So you need those additional confirmation. Those confirmation will let you know that if it is an actual double bottom, or if price is going to break the neckline. So our next pattern is a rounded bottom. So this is also a bullish reversal. So a rounded bottom identifies a series of price movement that forms a U shape at the end of an extended downtrend. This formation signifies a possible reversal in trend and momentum. So looking at the rounded bottom, a few of you guys may look at it and it probably resembles a cup and handles, but you will come to see that there is a difference between the two. They do look familiar, but there is a slight difference. So with the rounded bottom, usually you would have price consolidating for a while, right? And from there, you'll see that price drops. So the first part of a rounded bottom is the downtrend. The downtrend is where it will meet a resistance here, right? And then price will start to fall. At these points here, you do not try to get into the trade. You wait to see where price is going, because you want price to be stable, to find a bottom to where it could reverse. And that's where we come in on the second part, which is the bottom. This is where usually the down momentum from the first part usually just comes to a halt, and then price starts to consolidate a bit before meeting the mid section of the rounded bottom, which is where price usually starts to reverse to the upside, where you have momentum coming in, people starting to buy, so you're getting buying activity. And the third part is the uptrend. That's where you'll see that price starts to rise a little bit more and more. So with the rounded bottom, you have two possible entries. So your first entry, the safest entry would be at the break of the neckline here, right over here. This would be your safest and first entry that we would always recommend for you to get in. That's where the breakout is happening, and that's usually where a lot of momentum comes in, to where price continues to the upside. But you could also, if you're willing to risk, to get into the trade, or you are very confident that the formation is going to continue, you could also get a possible entry here midway of the uptrend, right in these areas, because as you could see, you could also draw a line in between here to draw a resistance level or a new neckline for this area here, where you could possibly find a breakout to the upside also. So what you should be looking for in a rounded bottom, of course, is you're looking for volume to support the reversal, right? And look for the entry at the bottom part of the break of resistance. So the break of resistance will be here, and that's where you'll be looking for entry. And of course, you need confirmation. So look for a bullish, formation candle, and that will be your an additional confirmation in terms of volume. That would be supporting the price movement. So moving on to the next one, we have a cup and handle. So like I was telling you guys before, you could see the similarity between a cup and handle and a rounded bottom. As you could see, they look almost pretty much the same, but with a slight difference. Remember that with a rounded bottom, usually price is consolidating. Is pretty, normal in terms of consolidation before going into a downtrend. But with a cup and handle, price is coming from the downside to the upside, right? So you'll have price coming here only to get rejected at a resistance level over here. So looking at a cup and handle, the cup and handle is a bullish continuation pattern that is used to show a period of bearish market sentiment before the overall trend finally continues in a bullish motion. The cup appears similar to a rounded bottom chart pattern, and the handle is similar to a wedge pattern. So not only that the cup and handle has a bottom formation, like the rounded bottom, it also has a wedge right over here that is shaped when you tie it to the cup. It is shaped as if it's a handle of a cup. So going back to the different parts of a cup and handle, the first part you will have is the downtrend. So you get the downtrend from the previous uptrend. So you will have an uptrend going up here, and then only to get rejected at this resistance level to where it will go into a downtrend. And of course, you don't want to get into any type of trades within the downtrend. You would want to wait until price and momentum steadies a little bit to where you have a little consolidation period before price starts going up. So just like the rounded bottom, you may try to execute an entry near the bottom. That's not the safest because that is halfway through the formation. So let's say you were to enter in this area, you don't necessarily know if price is going to continue to the upside. So the best entry would be at the handle formation when price comes all the way back here only to get rejected. So when looking at the handle for the cup and handle, you want it to be a consolidation phase in terms of when price gets rejected here, you want to see price falling down slowly. You do not want to see a hard rejection. You want to see the price get rejected here at the resistance level, slowly comes down, consolidates a bit before breaking out. And this is where you will find your entry point at the break of the handle itself. And also look for volume to support the reversal and any possible bullish, candle formation, right? And always get into the trade at the break of the handle, right? Never within the handle because price could always just, continue falling. And at that point, it is not a bullish reversal anymore. It is not a cup and handle. So moving on to the next formation, we have a rising wedge. A rising wedge is represented by a trend line caught between two upwardly slanted lines of support and resistance. In this case, the line of support is steeper than the resistance. So looking at the resistance, you see you have a mild upward resistance, but comparing to the support, as the definition says, it is steeper than the resistance level. As you can see, it's a little bit more slanted and a little bit more aggressive. So if you're looking at the bottom formation of price action, you'll see that each time that price goes up, it's creating a lower high. So these are the lows of the price action. Starting from here, you'll see that this low is lower than the previous one, and every other lows is a little bit higher than the previous one. So that's why the support line is as slanted as it is. So looking at the rising wedge some more, this pattern is generally signals that an asset price will eventually decline permanently. which is demonstrated when it breaks through the support. So like it says, you will have a consolidation period between a resistance and a support level to where you're not really seeing any breakout. It looks as if the price is trying to break to the upside, but it's really having a hard time doing so. And eventually you'll see that price starts to break the support. So you'll look for entry as price breaks support always, right? And you'll avoid false breakouts with bearish candle formation. So what do I mean by false breakout? Sometimes you'll see that price seems as if it's going to break the support level and then only to just go right back up into the consolidation phase, right? With these types of pattern formation, you're looking for breakouts, right? You're not looking for price to consolidate and wait for it. You want to get in as soon as the breakout starts, but you need additional confirmation for that breakout. So you're going to look for volume to support that breakout, and you're going to avoid false breakouts with bearish candle formations, such as the bearish engulfing candles, the three black crows, evening star, shooting star, and hanging man. So moving on to the next pattern, we have a falling wedge. A falling wedge occurs between two downwardly sloping levels. In this case, the line of resistance is steeper than the support. A falling wedge usually indicates price will rise and break through the level of resistance. So, as opposed to the rising wedge, we have the falling wedge, right? And as the definition states, the resistance is steeper than the support. So you'll see that the resistance, is more aggressive than the support. You have a slight decline on the support while you have a major decline on the resistance, right? So just like the rising wedge, you're looking for a breakout. So look you will look for an entry as price breaks the resistance. Remember, this is a bullish this is a bullish formation, the falling wedge. So you're looking for entry at the resistance where price is breaking out to the upside. And of course, you're going to avoid false breakouts with bullish candle formations, such as the hammer, the inverse hammer, the bullish engulfing, morning star, the three white soldiers. Any type of indication that confirms a valid breakout to the upside, those are what you're looking for. And also, you're looking for volume to come in to support the price action to the upside, because let's say you don't have any volume, you could have a break to the upside for a while, only for price to fall right back into the falling wedge, right? So the next one that we'll be looking at is the pennant, or you could also call it a flag. So the pennant patterns or flags are created after a cycle of upward movement on an object followed by a consolidation period. In general, a large increase will occur during the early stages of the cycle until it begins a sequence of smaller upward or downward movement. So the pennant, it comes in various forms, as you will guys will come to see. But one of the main ones is just the pennant itself, to where price, right? Price will usually be consolidating and then only to come into a pennant formation where it's not really breaking out to the upside, nor is it breaking down to the downside. So this is a breakout trading formation right here. So you'll be looking for entry where price is breaking out. So if you see price breaking out, to the upside, breaking the resistance, then of course you'll look to enter a position, that you could benefit from that, which would be a call. So as all the other formations prior to it, look for entry as price either breaks support or resistance, because this type of formation, like I said, price could break out either way. It's wherever that you see that price is going to, that's where you'll look to take into to get into the trade. So for this example here, it is breaking out to the upside, so you would want to get into a call, because the pennant could be either bullish or bearish. and they basically they also represent a continuation or a reversal. So you'll guys, come to see what I mean by that. And always look for volume to support the breakout. Always. So the next part of the pennant, well, the next part that we'll be looking at is an ascending triangle. So the ascending triangle is a bullish continuation pattern that suggests an upward trend should continue. Ascending triangles can be drawn by putting a horizontal line along the swing highs. So these right here will be your swing highs because price is swinging higher. So this is the horizontal line right here, right? And then drawing an ascending trend line along the swing lows, which will be the support. So your swing lows are right here. These are the part where price comes back down from the resistance. Those are your swing lows. So this is how you'll go about, drawing the ascending triangle. So another thing with the ascending triangle that you will see is that resistance is typically around the same levels, right? You'll see that price come back to test those resistance levels pretty much at the same price every time, right? And always it will get rejected. But the good thing is that every time it gets rejected, price doesn't go lower, right? So that's one key thing to look at. So you'll see the first upward trend here, it got rejected at resistance level, price came back down, right? Only to find support at these levels here, only to go back to the upside, right? And then it gets rejected again. But if you're comparing this previous low here to this one, you'll see that this one is a bit higher than the previous one, and so are the others. So you're seeing price rejection at the resistance, but you're not seeing that price is really trying to fall below support, because every time you get a rejection, you're getting a lower high, right? A lower high. So at some point, you're going to have what that's telling you is that price is holding support and wants to break to the up top, right? Because as you see, as price move up, as you get further up to the support, you'll see that the support is closing in on the resistance level. It's kind of like squeezing price to the upside. So that's one way you could look at it. And of course, you're gonna look for entry as the breakout happen, right? So, of course, avoid false breakouts with bullish candle formations, of course, such as the hammer, inverse hammer, bullish engulfing, morning star, the three white soldiers. Always look for those candle formations when you see, a breakout to the upside. And of course, you want that breakout to be supported by volume. If there's no volume, that price action is not going to hold, and you do not want to get into the trade. You want as much confirmation as possible. So moving on to the next formation, we have a descending triangle. A descending triangle signifies a bearish continuation of a downtrend. Descending triangles can be identified from a horizontal line of support and a downward sloping line of resistance. Eventually, the trend will break through the support and the downtrend will continue. So, as you can see here, like it says, you have your support level going through and your resistance coming down right over here. So usually there'll always be a consolidation phase, right? It's not more of a yeah, you could say a consolidation phase, but the swings are a little bit too high to call it that. So you'll see that price always, bounce up on support, and as you could see, the resistance it's always getting rejected at the resistance, only to come back to the support. And similarly to the previous formation, you'll see that the resistance level, right, as you get closer, as the resistance level get closer down to the support level, you'll see that it is squeezing price downwards in a way, because you'll see that every time that price goes up, comes back down to support and comes back up again, the highs are always lower than the previous. So you'll see the first price rejection at support here, where you have a resistance level here before price gets rejected, and then comes back down and comes back up as you can see, if you're comparing these two right here, you'll see that the first one is higher than the second, right? And then the second is higher than the third. Every time you get a rejection as support, price comes back up, it's always lower than the previous. So that's one way you can look at it in terms of, price is, basically not trying to break any higher, because all the previous highs are higher than the current one. And then eventually you will have, you will come into this part of the triangle to where price doesn't really have anywhere else to go but down, because resistance is getting tight, and the next swing up will only cause price to come down, dramatically, which it did, as you can see here. This rejection caused price to break out, and of course, during the breakout, that's where you're looking for entry, and you have to look for bearish candle formation, right? Like the bearish engulfing, for example. That's a very popular one that you could use in those type of breakouts, right? And always look for volume, guys. You want volume to be supporting to support your price movement. If it's not, then most likely it won't hold. And usually after a breakout to the downside of the support, sometimes you'll see that price does try to come back to the support level, but only to get rejected, right? So sometimes you'll see the breakout, and then all of a sudden you see that price starts to move back to the upside. Usually it will get rejected from the support level, only to continue down the resistance line. So the next formation that we have is a symmetrical triangle. The symmetrical triangle pattern can either be bullish or bearish, depending on the market trend. It is a continuation pattern, continuing price action in the same direction as the overall trend once the pattern has formed. So right here with the symmetrical triangle, as the definition says, it is pretty neutral. Usually you'll have a consolidation phase where price is not breaking higher, nor is it breaking lower, right? You'll have a higher low, and you'll have a lower high, to where price seems to be getting congested in this area here before it chooses a direction to break out to. And like I said, it could either be to the upside or the downside. That will depend on either the current trend. So for you to know which side that it would usually break out to, you'll usually need to know what either the current trend of the market or the current trend of the asset that you're trading. So based on that trend, it will give you an initial idea of where price will break out. So always look for support, always look for entry either at the support and the resistance, wherever price seems to be breaking out of, and look for volume to support price breakout. So another part of the symmetrical, just to show you guys in terms of the trend, because like I said, a trend will give you an idea of where price will break out to. So putting the symmetrical in a downtrend, you'll see that it will continue the downtrend, right? So looking at price falling from here only to stop and consolidate a bit before choosing a direction, right? So this will be how you would use this would be how to use a symmetrical triangle to enter a put position, to take take advantage of the downtrend. So you'll see it consolidates a bit only to continue going down, right? So like I said, a symmetrical triangle is usually a breakout happens on either both sides, but once you add a trend to the symmetrical triangle, it would have a definite direction, as you could see with the downtrend, to where price came down, started consolidating within a symmetrical triangle, only to break down to the downside, to continue down to the downside, right? And also look for volume and wait for a break of support for entry, always. And another example would be the symmetrical triangle in an uptrend, right? So with the uptrend, you'll see that price breaks out to the upside, only to stop and consolidate within a symmetrical triangle before continuing to the upside, right? So you guys basically just have seen three variation of the symmetrical triangle. Uh, the first one being where it's neutral, to where you probably have a consolidation phase within, the asset that you're trading. It may not have a definite trend, but usually when that happens, you want to see a breakout either to the upside or the downside. So it's pretty neutral, right? But you have a second example of a downtrend to where it becomes a continuation pattern. A continuation pattern being for the downtrend on this side, to where price was falling, enter the symmetrical triangle, only to continue down to continue breaking down. And then the third example of a symmetrical triangle was within an uptrend, to where you have, price breaking out to the upside, only to consolidate within a symmetrical triangle before continuing to the upside. So the symmetrical triangle is very volatile in terms of, either uh, either being able to, put it in an uptrend or a downtrend, or without necessarily needing a trend at all. You could apply that symmetrical triangle to any type of, price movement within the market or within the asset. And of course, you are going to look for volume to support, those breakouts. And you're going to wait until, it either breaks resistance or support, depending on the trend. So that's pretty much it in terms of the 10 uh, formations. Chart formation that you guys could use. You have some bullish ones, you had some bearish ones, and you had ones that were pretty neutral, like the ascending triangle. So this is pretty much it. Thank you for watching. I hope you enjoyed and learned a lot from the video. Go ahead and smash that like and subscription button, and follow us on social media for more content. And stay tuned for the next video.